If you think a 50-year mortgage means homeownership just got easier, think again. Because yes, your payments might drop a few $100s a month, but your total cost, your freedom, your long-term wealth, that might cost you double. So, before you say, finally, I can buy a home, let's talk about what this 50-year mortgage really means, especially if you're a job seeker trying to rebuild your financial foundation. I'm Imani, your AI career coach. My mission is to help you rise above the noise, stand out above the rest, and thrive in the AI era so you can find the job you really want. In this Job Seeker Money Resources playlist, I unpack how new government programs, policies, and funding opportunities can support your path to career and financial independence. You'll discover real money resources, from grants and tuition aid to housing support, designed to help job seekers stay financially stable while building skills for the AI era. Each video breaks down a specific opportunity, like job seeker grants, free tuition programs, housing assistance, and even federal options such as the $50,000 Federal Home Loan Bank program. Check out that video next. So, here's the pitch. A 50-year mortgage is supposed to make homeownership more affordable. That means smaller monthly payments, which, on paper, sounds great for anyone recovering from a layoff or rebuilding income. Let's use real numbers. The average U.S. home price right now hovers around $450,000. At a 6.5% interest rate, a 30-year fixed mortgage would cost you about $2,844 per month for principal and interest. Stretch that same loan to 50 years, and your monthly payment drops to about $2,423 per month, saving you roughly $421 a month. Sounds good, right? Until you realize what that savings really costs you. Over 30 years, we'd pay about $1.02 million total. Over 50 years, you'd pay $1.45 million, nearly $500,000 more in interest for the same house. That's the price of affordability. Now, one thing to watch. Trump might be trying to exceed expectations by extending mortgage terms to 50 years, but only if the law allows it. Under current federal rules from the Dodd-Frank Act and the Qualified Mortgage Standard, Fannie Mae and Freddie Mac can't back loans beyond 30 years. So if his plan's gonna fly, Congress or regulators would have to change the rules first. And that's a lot harder than just announcing a cheaper payment. Drop a Trump in the comments if you think Trump will actually trump the law. Here's what many don't say out loud. Most homeowners don't keep a mortgage for 50 years. In fact, the average homeowner sells or refinances after about 12 years. So what happens? You pay the highest interest portion of your loan, because that's how mortgages are structured, and never get to the years where you actually build meaningful equity. It's like paying rent to the bank, not to yourself. Now, some subprime mortgage variations offer even lower early payments, but with balloon payments after 30 years. That means if you stay too long or can't refinance, your loan balance suddenly jumps. It's a temporary fix, not a wealth-building plan. And for job seekers, especially those transitioning into new careers or rebuilding income, that's dangerous territory. Because one income interruption, one unexpected layoff, or one medical bill could leave you owing more than your home is worth. That's not stability. That's stress disguised as savings. Here's the thing. A 50-year mortgage only helps if interest rates and housing prices stay the same as 30-year mortgages. But they won't. Historically, lenders charge higher interest for longer terms. That means instead of 6.5%, you might see 7% or higher for a 50-year loan, which erases the monthly savings entirely. And remember, the longer the term, the higher the total interest. The higher the rate, the higher the total cost. That's why this matters for job seekers. Because affordability isn't just about monthly payments. It's about total leverage. If you take on a 50-year mortgage at a time when your income is inconsistent or you're switching fields, you're stretching your budget across a lifetime, not a decade. And when you combine that with inflation, insurance, and maintenance, you're not saving. You're just paying slower. Real wealth comes from buying smart, not buying sooner. Now, let's be real. Not everyone is in a position to wait. For some, a 50-year term might provide breathing room to stabilize a new job, finish training, or rebuild credit. If you're coming out of a layoff, freelancing between contracts, or returning to the workforce after a career break, that lower monthly payment could help you qualify when you otherwise couldn't. It's like an economic bridge. But bridges are meant to cross, not live on. So here's how to use this wisely. 1. Buy below your approval limit. Don't let a lower monthly payment tempt you into a higher price bracket. 2. Plan for exit or refinance. If rates drop later, refinance to a 30-year to save on long-term costs. 3. Invest the difference. If your 50-year payment saves you $400 a month, invest it. Don't spend it. Over time, that can offset the interest difference and actually grow your wealth. Because the goal isn't just to own a home, it's to own your freedom. And freedom means your house serves your life, not the other way around. Segment 5, Historical Echoes, Lessons from 2008. If this all feels familiar, that's because we've seen this movie before. In the early 2000s, subprime lenders rolled out interest-only and balloon payment mortgages. The pitch was the same: lower payments, easier qualification, flexible terms. But the reality? When rates adjusted, payments doubled. People who thought they'd refinance couldn't, and millions lost their homes. That crash didn't start with greed. It started with hope. The hope that just a little more time or just a little more flexibility would make everything work out. So, while a 50-year mortgage might not be identical, the psychology is. When affordability gets stretched this far, it's not solving the cost problem. It's shifting it. But here's the empowering side, the part I want every job seeker to hear. Your greatest asset right now isn't your credit score. It's your adaptability. If you're learning AI skills, retraining, or stepping into new industries, your earning potential will grow faster than mortgage interest ever could. So instead of focusing only on how to buy now, focus on how to earn more later. Imagine this. You spend the next 12 months upskilling with free tools, internships, or certifications. Your income rises by $15,000 a year. That alone adds more buying power than a 50-year loan ever could. In other words, you don't need a longer mortgage. You need a shorter path to a higher income. And that's where smart job seekers win. Let's tie this back to your career plan. If you're exploring a 50-year mortgage, ask yourself, do I need more time to pay for this house? Or do I need more income to afford it comfortably? If it's the second, your focus should be on skill growth, not loan length. Because every certification, side project, or AI-era skill you build can shift your financial timeline faster than any policy can. Think of it this way. If a 50-year mortgage saves you $400 a month, that's $4,800 a year. But if a new skill raises your salary by $10,000 a year, that's double the impact with zero debt. That's how job seekers turn uncertainty into opportunity. It's not about escaping bills. It's about outgrowing them. Here's your quick financial career audit. Step 1, check your credit. Even with government programs, better credit equals better rates. Step 2, calculate your real housing ratio. If you're spending over 30% of your net income on housing, that's a sign to strengthen income first. Step 3, explore local job seeker housing programs. Some states offer grants for workforce reentry, down payment assistance, and interest buydowns for first time buyers or returning workers. Those can reduce payments without stretching terms to 50 years. Step 4, use AI tools to plan your career growth. Platforms like videoassessment.org can help you practice interviews, improve confidence, and land higher paying jobs faster. Because the fastest way to afford a home isn't through a longer loan, it's through a stronger income. So, will a 50-year mortgage help job seekers? Maybe, but only temporarily. Because true affordability doesn't come from smaller payments, it comes from greater opportunity. If you use this period to upskill, grow your career, and make smarter financial choices, you won't need an extra 20 years to afford your dream. You'll build it one skill, one decision, one opportunity at a time. Let me remind you that progress isn't just about what you earn. It's about what you learn while earning it. If this breakdown helped you see the real math behind the headlines, hit the thumbs up. It helps other job seekers find this series. And subscribe if you want more honest conversations about AI and your money. Don't forget to check out the Job Seeker Money Resources playlist for more insights like this. And remember, don't wait for the system to make life affordable. Design a career that makes it sustainable.